Welcome back to Morning Markets on Monday the 6th of February. Last week we had a very strong week for equity and bond market returns as markets gauged further evidence of inflation coming down at a headline level, which is bringing central bankers closer to the end of the interest rate hiking cycle. This was also complemented by an improvement in the sentiment of manufacturing and service sectors in the UK, the US, Europe and indeed China. For context, in sterling terms, global equities were up 4% through the course of last week and global bonds up 0.4%. In addition to the positive sentiment data, on Friday we had some important prints from the US in regards to the health of the labour market. At this point in time, the labour market in the US is incredibly strong, and this is an aspect which the Federal Reserve have acknowledged as it's driving wage inflation at this point in time, and that's a headwind to the central bank in achieving their strategy of bringing inflation down to a level of 2% at a core PCE level from current levels of 4.4%. If we just break down those employment indices which we received on Friday, one example is the non-farm payrolls in the US, farm workers excluded to moderate the impact of seasonality. So at a time when the Federal Reserve is trying to cool the labour market, in January, we actually saw more than 500,000 jobs added to the labour market. This was 401,000 more than what was expected, given the signs that we're seeing in terms of slowing economic growth and also a number of media headlines which are focused around technology companies streamlining workers. And if we look under the bonnet in terms of where that job growth was coming from, it was primarily within the service sector, but the breadth of that was quite interesting. We were seeing job growth across leisure, hospitality, legal and professional services, transportation, but also healthcare. So quite broad-based in terms of where we were seeing job growth. And in terms of the unemployment rate, we've been talking about unemployment at multi-decade lows, 3.5% in the US. The expectation was for unemployment to tick up by about 0.1%. Actually, it ticked down to 3.4% at this point in time, and that's even as the participation rate increased, which is a really interesting aspect. Given the tightness of labour markets, we are also still seeing wage growth coming through, so average hourly earnings in the month of January actually ticked up 0.3%. For a longer term context, 12-month wage growth in the US has been around 4.4% to the end of January. The data print caused bond yields to move higher across all maturities in terms of the US bond curve. European bond yields also rose, but this was more after we seen the producer prices indices, which didn't soften to the magnitude which was expected by markets. The reading did demonstrate a slight softening. This was primarily through energy, but not to the extent as was expected. For context, producer price indices rose by 24.6% year on year in December, and this was above the market expectations of 22.5%. In terms of the key aspects which are coming up this week, we'll see more in terms of US earnings, so companies coming out reporting their earnings for the fourth quarter, companies including Philip Morris, PepsiCo and Uber. We also have the Reserve Bank of Australia meeting on Tuesday. We've got Chinese inflation data coming through and the fourth quarter economic growth print for the UK. So some important aspects through the course of this week. We will keep you up to date here on Morning Markets. Thank you for watching.
If you're interested in taking your investing to the next level or would like to know more about the options available to you when you retire, then download our free guides to ISAs and pensions. These are available in the video description below.